Maybe, is it too hot? Is it too cold? Or are we stuck in the Goldilocks zone of just being right in this weird economic circumstance of are we coming or going? Because if you watch tech earnings where you want to be hiding out, where there's all the technology, the AI, the future innovation, and the beautiful juicy tendies that we've been printing lately live, or do you want to be in these dividend companies and the lower half of the S&P, which has been a very mixed story thus far, as we're going to be discussing CocaCola, Starbucks that dropped 10 friggin' percent in after hours. We'll talk about McDonald's and comparable, along with the tech giant that was Amazon that just posted earnings, and the MJ markets are exploding right now. We're going to explain to you why, and if that is a conversation you'd appreciate on your path to financial independence to perhaps one day retire early, consider hitting that like button. Damn it, while you're down there, hit that subscribe button to join me, because Amazon, yes, posted earnings, but it doesn't seem to be helping the market at all. I mean, you take a look at the Schwab US Dividend Equity ETF, which is keeping my portfolio up today, but the broader market's getting wrecked. I mean, we're down 1.8%. I won't even talk about the individual positions. Let's just shroud away from that aspect of it and get into the earnings cycle that has been largely dictating where we've been going. And I've told you, last week and this week are the most pivotal moments for where the market's going to go. Like, it's going to dictate whether we stabilize or whether we unstabilize. And it's a mixed bag, as it has been since the pandemic. Let's be real. Nothing can be perfect anymore because we're in the twilight zone. The pandemic took us on a whirlwind that's been freaking 4 years already, and we're not back to any place of damn normality. It's crazy to consider. Actually, it's kind of wild when you think about it. But we've got PayPal that posted, McDonald's. We're going to talk about some of these companies. Got Amazon in here and Starbucks. And these companies, I think, really represent the kind of instability and the concerns within the broader economy, because like JP Morgan's CEO Jamie Dimon said, he's like, don't get too bullish here, because you go back to the 70s and some of these inflationary markets, everything was fine until it wasn't. And I don't want to get fear mongering here, because I'm still overly bullish in the market, because when you look at companies like Amazon, for example, though the stock is not rallying on earnings, it's kind of just flatlining. I feel like it's having a bit of a heart stutter. If you take a look, I mean, Amazon beats on the top and bottom lines driven by growth in cloud and digital ads. And if you take a look at this, I mean, are we complaining? I mean, net sales went from 127 billion to 143 billion dollars. I mean, look at this. Their net service sales, 70 billion to 82. Their net product sales from 57 basically to 61 almost. Unbelievable. And they've obviously done some adjustments to bring their net income up. I mean, their earnings per share diluted 31 cents to 98. My God, muy bien. Now let's clap for the attendees that should have been printed that aren't. It's like, how did Meta drop and Google went? Like, nothing makes sense right now in this freaking market. But Amazon is in a beautiful place. E-commerce is not going anywhere. It's a great stock to hold, in my opinion. God, it never seems to fail growth. Now, if you look at something like McDonald's, however, the stock stuttered a bit, right? And this is one of those companies where I always told you guys, if you're buying it, you always want to buy it on the dips. It does do pretty significant dips of about anywhere from 10 to even 30% on a good day. And if you can pick it up somewhere in between, your rate of return has been exceptional, because the stock tends to go from overvalued to undervalued on a bi-monthly basis almost. I'm not really sure what causes that volatility, but the fact is that there are some concerns here. And McDonald's is kind of catering to the lower end of society. And I don't mean that in a bad way. I mean it like, I'm cheap. I don't go to Starbucks. I'm frugal. I go to McDonald's. It's the place that us cheap people like to eat when we're out sometimes. Not all the times, but sometimes, right? But the CEO said, it's clear that the broad-based consumer pressures persist around the world. This is coming from the CEO of the fast food chain on earnings, their earnings call on Tuesday, that consumers continue to be more discriminating with every dollar they spend as they faced elevated prices in their day-to-day spending. We've seen this with Procter & Gamble and a bunch of other companies. The demand for the products have been flatlining or even going down, yet they're beating that by increasing the prices, right? That's what has been driving a little bit more revenue, and they're able to play around with a bit more margin there, because when we look at McDonald's here, right, like this company's still doing exceptionally well. I mean, the revenues up 5%, their earnings diluted were up 9%. But we're not talking about explosive growth, but still stabilizing as comparable sales results, and this is in the U.S., benefited from average check growth driven by strategic menu prices increases, right? So that's what's been giving a lot of U.S. growth here. International operating markets, the segment performance was driven by positive comparable sales in markets led by the U.K. and Germany, partly offset negatively by comparable sales in France. They have this nice, beautiful balance where one country or province underperforms, another one can kind of make up for it. International and development licensed markets, though, are continually impacted by the Middle East, more than offset comparable sales in Japan, Latin America, and Europe. So that's McDonald's, right? things are hunky-dory. It's a recession-proof kind of company. Pick it up on the dips, you're doing all right. Talking about dips, we should talk about Starbucks because I ain't that bougie, baby. I can count on probably one hand, realistically, how many times I've ordered Starbucks. Nothing crazy. It's going to be paying a 3% dividend yield here very soon because the stock is down 10 damn percent in after hours. And this is abysmal. It's painful. It's basically Starbucks shares sink as basically same store sales fall, quarterly results miss. It's not like looking great. In a highly challenging environment, sound very similar to McDonald's, this quarter's results do not reflect the power of our brand, our capabilities, of the opportunities ahead. And this is coming from the CEO. It did not meet our expectations, but we understand the specific. Yes, if you can hear them honking out there, I get it. I know it's rough, but honking at the damn drop in Starbucks. But basically, the specific challenges and opportunities immediately in front of us. The shares of the company fell 10%, earnings 68 cents for 79 cents expected, blah, blah, blah. Let's just read into this very quickly here because basically their North American segment of 6.4 billion for the second quarter were flat in comparable, primarily driven by a 3% decline in comparable store sales, driven by a 7% decline in comparable transactions, and partially offset by a 4% increase in average tickets. So this is scary, right? They're increasing the prices, but they're seeing store sales decline. That's not exactly what you want to see here, right? Operating margins of 18% contracted from 19.1% the prior year, primarily driven by deleverage, incremental investments in store partner wages and benefits, and increased promotional activity. So, there was a big thing about unionization. They're probably fighting to pay more money. This contraction was partially offset by pricing in store operational efficiencies. It's kind of bullshitting a bit. They're like, things aren't that great from a sales perspective, but we've increased prices. Honestly, if they didn't increase prices, things might be a lot worse. So basically revenues, again, down 5%, 1.7 billion, 1.75 versus 1.85. Operational income down 26%, which is abysmal. And operating margin here, not looking that great either, right? So this is for international segment compared to US segment. International actually getting hit a lot harder, which doesn't look that great either, right? So I don't know what to say about it other than I'm not that bougie. I'm glad that I avoid Starbucks because it's clearly not the most recession-proof company. I'm not saying it's a bad company. If anything, this could be a good buying opportunity for when the market rebounds. But again, guys, I can only buy what makes me comfortable in products that I physically use and understand. And I don't understand it. I don't get spending $5 to $7 on a coffee. I make it for pennies on the dollar from Nestle instant, right? Like I do appreciate a nice coffee once in a while. When we go out for pho or something, I'll get a Vietnamese coffee or something nice and treat myself. But treating myself maybe once every other week or month doesn't accumulate to buying a Starbucks coffee every day. It's nuts. It's crazy, but it's my opinion. I'd love to know what you think. So let's talk about PayPal real quick. I don't like PayPal. I have a love-hate relationship with them because I still use them for some transactions, but they're greedy, they're annoying. I avoid them, but that doesn't mean they're a bad company, though I don't think they have a lot of growth in the long run because of competitive aspects of the business. I mean, Cash App, Apple Pay, everyone's coming for their lunch now. There's no reason to say that PayPal has some kind of crazy moat. Outside of the branding power they currently have and the fact they have a huge client base. It's probably not going anywhere anytime soon. But basically, they beat on views. Essentially, they reported their quarterly earnings, which rose 27%. But don't get too excited because they had new accounting that included an impact of stock-based compensation. If you can change accounting like Enron did, and let's not call them Enron, but when you can change the accounting on how you look at certain assets, stock-based comp and stuff like that, you can manipulate your net earnings. And that's what they did here, right? Because first of all, growth in revenue volume, but again, total payment volume, let's not talk about revenue, payment volume grew by 14%. So that's good. That means people that are using the platform, again, they're doing more transactions than normal. That's what they said on the last earnings, right? It's not like they're seeing huge new user growth. They're just capitalizing on the users that are there. Net revenue was up 9%. Obviously, when you get lots more transactions, revenue is going to fall in line with that. That's great to see. Net income up 12%. Amazing. Again, you take a look at that free cash flow because of the new accounting rules. The free cash flow is exploding. Again, this seems like a nominal quarter for PayPal, and it's exactly what I would expect from a ballooned company, right? They're kind of getting to that place of maturing. A matured company will usually make 5 to 10%, even lower than that sometimes. Like McDonald's, we'll take a look at CocaCola. These companies don't have explosive growth rates anymore, and we're seeing that with PayPal. You can't expect this company. They're trading at a reasonable valuation. Sorry, that's Starbucks. I mean, they're trading for, the price to earnings is going to be manipulated here, I think, with free cash flow and earnings per share explosion stuff. But the company, trust me, isn't poised for some kind of explosive growth like people I think are just imagining it should be. Because again, I don't think it's doing what Amazon's doing. I don't think it's doing what Google or Meta are doing at double digit 20% like revenue growth, right? When you get into those mid-teens to double digit revenue growth is a growth company. When you get into the single digit growth, you're just a traditional company. That's kind of how I look at these things, right? So again, that's PayPal. And then we kind of get into these more traditional Warren Buffett oriented companies for those dividend lovers again. Coca-Cola, I'm really surprised stuttered like it has been. Again, the markets have just been really suppressed after the upbeat feeling of last week's earnings with a 3% yield right now. Coca-Cola not really going anywhere. And I don't know why PayPal should be at a phase where they should introduce a dividend. I think that would really pop the stock off as well. But basically, Coca-Cola reported quarterly earnings and revenue that topped Wall Street's expectations. The beverage giants also rose its outlook for the full year with organic revenue, which is even better. And Coca-Cola reported that its global unit case volume increased by 1%. So the company is, again, we're not talking about a huge growth beast here by any metric, but the company is growing nicely. I mean, you take a look here as we just kind of dig into this here. Let's say net operating revenues hit 11.3 billion versus 10.98 billion, an increase of 3%. Again, we're not talking about massive growth. Basically, if we take a look at net interest income has been going up. All these companies have been printing on their cash. All in all, like these were really good, right? Like you can't really complain here. They've been buying shares back. It looks like a very tiny amount of shares have been coming off the table as well. So all in all, current assets, company sitting in a really great place by the look of it. I can't complain, right? This is just one of those boring Warren Buffett companies. The growth days are behind it. I can't see growth coming out of this. But again, if you're in retirement, you want stability, that's when I would look at these companies. And honestly, I like Coca-Cola, McDonald's, these more, again, normal person-oriented product-based companies. I don't like Starbucks. I don't like the bougie brands. It's just me, right? But anyways, yeah, that's kind of where it comes down to. So let's talk about the MJ stocks because they've been exploding recently. This is wonderful. Puff, puff, pass, baby. That's what we're talking about right here with Canopy that has been on freaking fire, not over the last 5 years. Don't zoom out. Don't zoom out. Just zoom in. Zoom in. And it looks beautiful, right? I would avoid these like the plague. I've always joked that basically Canopy, this is the first stock I ever bought in 2014. And it is now trading at the same price it was when I bought it. But keep in mind, that's after reverse splits because it was trading for like $2 or $3 back here. And we went to the moon. We made a lot of money. We got out. It was great. And I'm shocked to say that the stock is cratered. I called this greatly and I should have shorted it into the ground because there's so much competition in this market that you can't compete. You're not allowed to market and advertise it. No branding deals are allowed to be done. It's kind of just generic, cheap stuff everyone and their grandmother can grow in their backyard legally now. And essentially they're surging because obviously the US is looking to reclassify them. And this is purely just trading activity and you should look at it as such. Don't look, like I said, if in my opinion, the only real money being made is basically stores that have really great moats and not a lot of competition around them. So like in little towns where you can find an MJ shop that's servicing a large area with not a lot of competition, they do well. But you go to somewhere like Toronto where there's one on every block, it's not doing well, folks. So I would be trading this rather than owning it here. It's crazy to try and think you're going to own this, but to be up 400%, that looks exactly like a stock that's going to pump, dump, and go left, right, center field, and all over the place. Maybe you know something about the MJ market I don't. Let me know if you're going long on anything here. I'd love to hear about it. We still got lots of earnings to come up this week, folks, including Canadian Natural Resources. Finally, some Canadian stocks. We're going to be getting Apple, Hershey. It's going to be a fun, fascinating week, and I'd love to know what you think about all of it in that comment section below.